And now, broadcasting from Titletown, USA, here's Joe Simon.
Well, welcome back. Time flies when you're having fun. It's another Joe Simon podcast. We've got a really smart guy named Matt Anderson on deck waiting to come in and address some serious stuff today. Long-term care. I know you've heard me talk about it before, but it just keeps coming up. And what we find out is, I started preaching about this in 1989, and people would stare at me and go, long-term care? I'm still trying to work on understanding IRAs and 401ks and having enough money to save for my retirement. And here we are, all of those people in their 30s and 40s are now in their 60s and 70s, and they're experiencing life in the fast lanes, kind of drinking from a long-term care fire hose. I know we're not here to make light of it today, but we just have to. It's a serious subject. So let's get right at it. We're going to look at the three things we're going to focus on today. Number one, we're going to talk about long-term care since the 2000s. Some bad stuff happened in the 90s into the 2000s with long-term care. The smart insurance industry didn't know quite how to get their hands around it, and everybody took a halt, a recess, a pause in how it worked. So we're going to pick Matt's brain on what he's seen from his perspective since that time and how it's grown up and I think gotten better. But we'll hear what Matt has to say about it. Number two, the continuum of long-term care and the products and how to self-insure. And there's a wheel we'll take a look at that kind of walks through that. We call it the continuum wheel for long-term care. It looks at, well, let's start on the left side and go all the way to the right side, the self-insuring, the traditional products, the things that we could consider and how that works. And then number three, anything that really makes this a real issue, a colorful scenario that has emotion to it. The old-fashioned way to do that is to look at case studies. And Matt and I are going to look at three case studies that I think are going to make this a reality. So without further ado, let's look at the costs. We've got a cost chart that we look at that kind of looks at what's going on here. Did you know that on average, women need long-term care for about 3.5 years? Men, on the other hand, it's about 2.5 years. The median annual cost of the private room around the nation for nursing homes, so this is a private long-term care facility, qualified, it's about 108,000 to, I've heard, as much as 11,000 right now. In a recent conversation just yesterday, actually, that someone here in Wisconsin was paying for their parents. The economic effect of caregiving, leaving their job. So that caregiver, what I've experienced, and Matt can share more, is it might start with a family member or close loved one. And by the way, most of the time it's the ladies in the family or the ladies in the circle, and the cost to the employer. So they're leaving their job to help a friend or a family member out. This is now around $44 billion of cost back to the employer when their employee checks out to address these emotional and needed issues. So I think that sort of sets the platform. Enter Matt Anderson. Hey, Matt, welcome.
Thank you, Joe. Thank you for having me. Excited to be here to talk long-term care and answer some questions that people may have.
Matt, we've had a few conversations and a couple cases to talk about. The beauty behind what we're going to get as we talk to you today is you are not product centric. In other words, you don't fly one flag. You're a broker that we rely on as our subject matter expert when we really need to go long and deep and really get this subject in the end zone for a client to understand. So what I like about how we work together on cases is we don't start with, well, how is this one case going to fit that insurance company? It's sort of the other way around. Here's our client and what's going to be the best insurance solution. for that client if that's the way they choose to go. And then sooner or later, the name of the insurance company sort of comes up in our case planning. But start with this.
Absolutely. But really,
Let's
my
start with a
job is
historical.
go ahead.
I was just going to say, let's start with the historical perspective on this as you talk about your relationship and our relationship with multiple insurance carriers. But, Matt, the reality of this is there's a lot of people that might sit back and fold their arms and go, well, here's an insurance guy talking about an insurance solution as if this is the silver bullet. Of course, these two guys are going to talk about insurance. Let's hit that nail on the head right away. Let's talk about the history of where this has come. As someone is listening right now saying, I'm just going to pay for this all by myself. We'll get to that throughout this particular quick podcast, but let's get a historical perspective from your eyes, first of all.
Yeah. So I think long-term care as an industry, it is relatively new, right? They started offering plans in the mid to late 70s. And this type of insurance typically has a 25 to 30 year run rate before we start to see actual claims starting to happen. So one of the things with LTC is that they didn't know how to price the product. They thought that it was going to act similarly to life insurance in some ways. But really, they found out that it was wrong, right? A lot of their assumptions were incorrect as far as how many people are going to be using this, how many people are going to retain this coverage. And there was a tremendous amount of mispricing going on with those early policies dating back to the 70s and all the way through really the 2000s and early 2010. And because of that mispricing, there was a whole bunch of carriers in the space that were selling a ton of this type of coverage, really traditional long-term care, without the actual knowledge of how things were going to work out in the end. And they lost a whole bunch of money. And we saw a mass exodus of a lot of the carriers that are in this space offering that traditional long-term care type of coverage.
It's interesting. So here's the insurance industry really at first stepping into something boldly. I remember those days. There were close to 100 insurance carriers that said, well, we sell life insurance, we do annuities, we insure homes. Why don't we just do that too? Without mentioning names, I remember one of the biggest insurance providers that also did other things, manufacturing other products, that decided, hey, we know what American consumers need and want. We're just going to roll out a long-term care insurance product. And the difference between that, from my perspective, Matt, is that we can compare that to, let's say, life insurance. Life insurance goes back to the 1400s. So there's historical actuarial data that an insurance carrier can dig into. Times change, people change, diseases, illnesses change, people get healthier for longer periods of time. That's all data that the insurance underwriters and actuaries had access to, but it's not the same as long-term care underwriting, is it?
Not even close, right? So one of the biggest things that the carriers misinterpreted was their lapse rate, right? So with life insurance, people will buy life insurance, hold on to it for several years, and then maybe they'll drop that coverage or transfer it to another carrier. They thought that the same would be true for long-term care insurance. Unfortunately, what they found is once somebody buys a long-term care policy, they hold on to that policy for life. And because they're not lapsing that policy, it really had a significant impact on their claims and how much money they're having to pay out at claim time. So a lot of those assumptions were drastically wrong.
So Christian, what I want to do is let's pull up that our producer Christian, let's pull up that continuum wheel where we take a look at, if you follow me here from left to right, it kind of swings up and then back down. This really is a piece that as listeners look in to kind of focus on. The insurance is pennies for dollars. We'll get to that in a minute, but there's always a solution to just self-insure. So Matt, let's walk through this together. There's self-insuring, there's annuities, there's life insurance with long-term care, rider, a combination product, and then there's the traditional long-term care insurance. A lot of people start with, well, I can either just save all my money and then I'll use my money when I need long-term care, or listen to these insurance guys and buy a big expensive traditional, all the way to the right-hand side, traditional long-term care insurance product. Maybe you can start us out, Matt, by looking at self-funding and your perspective on that, as it is a worthy way to do it. But let's just start with that perspective first.
Yeah. What I typically tell consumers is that I'm okay with whatever option they select, right? We've got an example of multiple different options here. And whatever option they select, I'm comfortable with. My only request is they actually take the time to look at what the options are. I don't want them to default into self-funding or self-insuring. But the concept with self-funding is I'm not going to buy insurance. I've got assets that I've built up and accumulated over time. And if I should need care, I'm going to use those assets to pay for the care that I should need. Usually we say it's a dollar for dollar, right? So you need a dollar of your savings to pay for a dollar of care that you need. But in reality, it's probably closer to $1.25 of your assets needed to pay for a dollar of care, because oftentimes the money is coming from a qualified account and taxes are needed to be paid before you can take that money out. But either way, you're paying, full cost of care yourself out of pocket.
What I want to jump in on with that, Matt, quickly is, this is real time. As of earlier this week, we were meeting with a 67-year-old widow. Let's say she had $1 million of asset value, which included the value of her home, which she still owed a mortgage of about $100,000 on. So it really wasn't a total asset yet, but we included it in there, minus that mortgage. And then half of that was qualified money. The other half was non-qualified, non-IRA money. So the rules are different in each particular case. So you're right. You're using qualified money. You're going to have to pay the tender, in most cases, the bridge tender, called the IRS, the Internal Revenue Service, for money that's never been taxed before, unless you're in a Roth IRA. I understand that. Maybe it's a 403B, 401k, or maybe it's a pension. I have a pension. I've been a worker that has a pension yet today. Very few of you. Congratulations. That's a great thing. However, you still have to pay the bridge tender on the taxes you receive from that pension. So just keep that in mind as we consider that self-funding perspective. The last thing I want to mention about that is, so we've lived through in 2025 some crazy times in the market, some record-breaking times, record drops, and record gains in a very, very short period of time that in the history of the market we've never experienced before. Why do I bring that up? I bring that up because if you're talking about long-term care, you're either toes on the line or all the way into the red zone, where can you really afford to take the kind of risk that you did 10 years ago to have that accumulation so you can pay for your long-term care and all the other things that you expect to have in your lifestyle as you get into those retirement years. So those are some of the speed bumps that we look at when we talk about self-insuring, right, Matt?
Absolutely. Absolutely. And it's a fine option.
Let's go back.
To self-insure it, as long as you've looked at some of those other options.
Let's go back to the continuum wheel for a minute, Christian. And so there's annuities and life insurance, two strong life insurance products that fall under the hybrid solutions umbrella. Matt, what are you seeing in those areas right now?
Yeah, just real quickly, as we're moving from left to right along the wheel, we're typically going to be seeing more and more leverage. Each dollar is going to be covering a larger amount of care. So in the annuity space, this is a very popular option for clients, typically, I'd say 60 to 87 years old. So a little bit on the older end of the spectrum. But what the concept is, we're going to do typically a single premium deposit into an annuity. It's going to grow tax deferred. And in addition to that annuity, you're going to get some type of leverage for long-term care. So just as an example, if you put in $100,000, maybe they're going to immediately give you $300,000 that you can access tax-free for LTC. And both the $100,000 is going to grow tax deferred over time, and your LTC pool of $300,000 is also going to grow over time, and you can access that tax-free.
Very interesting. So let's say I have a life insurance product right now that a few years ago I bought a long-term care rider. So it's kind of a snap-on in that. Describe the true feel of what that rider is. Why is that a good thing, or what are the limitations to that?
So there's typically two different types of life policies with riders. The first is simply a life policy with an LTC rider or some type of chronic illness rider. It gives you flexibility, right? So typically, if the death benefit is, call it $200,000, your LTC benefit is also going to be $200,000. And so maybe for an additional 5 to 12% premium, we can add on that long-term care rider. And now we can use that death benefit early in the event that we should need long-term care. I love that type of solution for someone that's maybe 40 years old that really needs life insurance, but recognizes that they may need some flexibility down the road when it comes to long-term care and want to be able to use that money early should they have a need that should arise.
So here's a question. We know that LIMRA shows that the majority of Americans, the only amount of life insurance that they have is offered through their employer. So it's a group life insurance product that's offered to them, usually no more than $50,000, usually term insurance. So I'm that guy. I'm looking at my papers right now and I'm going, hey, Matt, I don't see a long-term care rider on there. Why is that? Or should I go ask my employer to add it? What's the typical scenario we might run across in that situation?
Yes, I'd say you do want to be careful as to knowing what that rider means. A lot of times, maybe someone refers to it as a long-term care rider, but when you look at the wording, it doesn't say long-term care insurance. If it doesn't say long-term care insurance, that means that that rider is something else entirely. And so you really need to look at the definitions of what you're owning. We see a lot of times people have a chronic illness rider on a term policy, for example. So if I'm 50 years old and I have a 20-year term policy with a chronic illness rider, maybe that's been sold to me as my long-term care plan. The reality of the situation, though, is my LTC need is likely to happen beyond the age of 70 when that term policy expires. So in many ways, I'm kind of lulled into a false sense of security, thinking that I'm covered. But when I'm 70 years old, that coverage is going to go away. And that's when I start to get of the age that I'm likely going to need it. So definitely be very careful about the rider that you are looking at, because there's all different types. What you want to look for is that it specifically says long-term care insurance on the rider piece.
That's good to know. Good advice, Matt. Hey, we are running up on time, so we're going to do a part 2, a bonus part 2 for you followers. I realize that we didn't get into the case studies. I know Matt has some things that he wants to go deeper in. You'll find that in the part 2. What I want to do is go to my final thoughts today and also give you a bonus. The first thing is I have a special offer for you, and that is a long-term care blueprint booklet. It's an e-booklet. It's a step-by-step on the stuff we're talking about today. Who is it for? It's for the children of the parents that they're thinking about, and it's also for those adult children. So remember, email me. You'll get the details at the end, and we can send that e-booklet. It's a blueprint strategy for long-term care. And here's the walkaway for today. When you're looking at long-term care, have a plan. You're really never too young to consider this. Consider alternatives like life insurance or annuities with a long-term care rider. Pay attention to the maximum benefits and the local costs at facilities. Choose a suitable benefit period, for example, 3 to 5 years of coverage. Also, be aware of the elimination period, possibly a 90-day to a 1-year elimination. You want to think through that. And lastly, maintain consistent premium payments for continuous coverage and work with a healthy and smart advisor who's qualified to do that. So, without further ado, what we always like to say at the end is, have a prosperous day.
You've been listening to the Joe Simon Podcast. Big ideas with powerful stories and real-time solutions. Business succession planning, executive benefits, employee benefits, tax beneficial savings, and more. Remember, information discussed here today is dated and not specific to your situation. Always seek personal counsel from qualified advisors. For more about Joe Simon, go to davinciinsurance.com. Joe Simon is a licensed insurance agent in the state of Wisconsin. Licensed to advise on accident and health, life insurance, disability insurance, and annuities, as well as qualified long-term care insurance. Make sure to visit the davinciinsurance.com archives for more of our podcasts.